85% of all consumer purchases are made by women, and 80% of all healthcare decisions in the family are made by women. And one of the first things I said to Ross is that voice is not represented in a consumer investment firm.
Welcome back to the Fitt Insider Podcast. I'm your host, Joe Veneri. Today I'm joined by Ellie Rubenstein and Ross Iverson, co-founders of Manna Tree. In this episode, we talk about turning wellness into an asset class. Ellie and Ross share the firm's investment thesis for backing category-defining brands across nutrition, active lifestyle, and preventative health. Plus, we discuss the prevention economy, how consumer behavior is reshaping healthcare, and the shift from aspirational wellness to actionable outcomes. Let's get into it. The Fitt Insider Podcast is presented by EGYM. EGYM's smart fitness ecosystem is transforming healthcare through exercise. Combining strength equipment with AI-powered software and corporate wellness platform WellPass, it's leading the shift to proactive preventative health. Learn more about EGYM's intelligent workout solutions at egym.com. Ross, Ellie, welcome to Fitt Insider. Thanks for joining us.
Thanks for having us.
Thanks for having us.
Yeah, excited for the conversation. I think at the top, what we'll do is some quick intros for the both of you, and then we'll jump into the conversation.
I'm Ellie, co-founder and managing partner of Manna Tree, and I co-founded the firm alongside my partner, Ross.
Yeah, and Ross Iverson, Ellie and I met in really 2016, but launched the firm officially in 2018. And it's been a great partnership to pursue two passions that we both have, which are finance and health and wellness.
Yeah, I think from there, when you talk about Manna Tree and maybe obviously the health and wellness focus there, but getting that kind of stood up, I think a lot of people, and we talk to a lot of people at Fitt Insider who kind of come to the industry as like, hey, I'm very passionate about this. Personally, I was, an athlete, or I use a lot of these products, so I'm very interested in it. And then whatever that kind of background is, whether it's MBA or investing or finance, how did that, both in terms of your personal interests and then like this partnership, really take shape?
So you mentioned my passions. I was an athlete. I was a ski racer. I was also an injured athlete for several times. So I think I learned health optimization before the word biohacking exists. But I also had a deep love of consumer products. And I think that when it came time to figure out what I wanted to do, I didn't see myself as a former athlete sitting in New York City where I would have to wear a suit and normal business attire. I really wanted to be able to feel like we had a culture of athletes. So I was first connected with Ross as mainly as somebody who could help me get my views and values across at the time what was a family investment office. I didn't come from a family that actually saw food and beverage as a serious investment thesis. And Ross's background, I'll let him get into it, but that was how we were connected. And it also, I didn't have the operator background. I had sort of the passion as being an athlete and a consumer and in working in private equity. But I think at the time, private equity wasn't exactly known in consumer as helping founders build companies. And so I wanted somebody that matched my values, but could also help build a firm. And so that's why when I was introduced to Ross, I said, do you want to help build something? And so I think we were both really connected around building a brand as a private equity firm, which really hadn't happened at the time. And then last but not least, I did get double masters in agriculture economics in Purdue. I wrote my essay on how I sourced my own food, begging to get in. And I remember they called and said, we don't have seafood in Indiana, but no problem, we'll let you in. And so I think like Ross kind of lived through like the Purdue years of when we were kind of iterating. As he said, we met in 2016 and I was in grad school. But I think like most entrepreneurs, you kind of want to do something better. And at graduation, Ross and I approached my dad and said, we're going to spin out and go build a firm. So that's kind of how we met.
Yeah, and I mean, to pick up on that, I always say I'm an entrepreneur by heart, but I've never had my own great idea, but I can spot a great idea. And so I've partnered with a lot of great visionaries. And, I think the difference with when Ellie approached me was, how do we make this into an asset class? And so we all know that this industry's full, and there's a needed venture part of this industry, and athletes invest, family offices invest, wealthy founders reinvest, but that tends to be 2, 5, maybe $20 million checks. And Ellie kind of, I sat down and we said, what these companies really need is they need 25 to $100 million checks to get them to sustainability. So we all know thousands of companies start, but not a lot of them can make that stair step and be around for 20 years. And that's kind of where we honed in on is they said, what if we can be the experts at partnering with these groups when they hit 30 to 50 million in revenue? And how do we get them to 200? Because once you're at 200, you probably have at least national distribution. You might have a chance to go international, but there's a really good chance that consumers are going to get access to your product.
A couple things that you mentioned there stand out. One being this idea of really building a brand around the firm in private equity, which is, again, you alluded to it, Ellie, like not exactly the place that maybe people start or what's in the initial kind of focus, and then taking this and really making it into an asset class, which I think broadly is popular and mainstream as wellness has become. I don't know that we've kind of seen this in the same way that now people talk a lot about sports and sports ownership as an asset class, but not maybe that same approach. Were those things present, and how present were they at the founding, and how did you really kind of embed that into building the firm and make sure it's not something that's just kind of, hey, you point to it maybe after the fact and say, oh, let's hope to do this.
Ross is a finance guru. And I think one of the things I said to him is if you look in legacy of my family, my father was unique in that while he was in private equity as CEO, he had been a fundraiser, not the investor per se. And I said to Ross, like, we're not going to use placement agents, which in private equity is traditionally how you would go and enter the business to raise capital. I said, we're going to just have relationships. And I think that when you have a partner that, again, it's like a marriage, right? It's matching your financial values to how you want to build something. So, in true athlete form, as Ross knows, I went on the road 323 days to 18 countries, 19 states in 2018 and 2019. That was basically how we built the firm. What allowed with that was Ross managed the budget where we could build around travel. And we viewed travel as meeting people and experiencing and sharing meals, because at the time we were predominantly food and beverage. I will say also, Ross was able to take something that may have been an academic concept and say, okay, and I had kind of grown up in Alaska and was aware of the seafood model. But what was different was that you would usually own a commodity. And then Ross, in his great architectural visioning way, was able to draw something out conceptually showing that you would be vertically integrated, which meant this, the manufacturing, the distribution, and the brand, but you wouldn't own the commodity. And so that's kind of how Vital Farms was a bullseye of what we did in the sense of it was a franchisee model. So I think that there was a lot more rigor that kind of came into it, but I do think that where you spend company, and I say that because in Fund 2, there wasn't travel. And so Ross just poured money into marketing.
COVID actually gave us the pause of saying, okay, we've got this brand of Manna Tree. We had investors in 18 countries, over 100 unique investors that wanted to back us from day one, which is pretty unique. But then you go into this virtual world, and I just was like, okay, now we need to use our marketing chops. I mean, you obviously have built a great platform online, but this is when we could do webinars and education series. And then we really leaned into building our own database. So we've got over 6,000 people we interact with every single month with our newsletter. We're getting close to our 10,000 LinkedIn followers, which for a firm like our size is pretty good. And so you have to learn how to translate your passion and your mission into some type of marketing format in order to scale.
How much of that, even now, whether it's the travel, whether it's online, whether it's building a platform, is it reaching out and informing people in terms of deal flow, in terms of investors, in terms of just thought leadership and your perspective on things? Because it really does, and this is something we obviously put a ton of time into thinking about what that platform looks like and what role you're trying to achieve by doing it. Oftentimes, best of intentions, it's like the serendipity of the chain of events and network effects that you didn't even maybe see happening that kind of play out. What has that experience been like trying to build this platform?
Still, like why I say Ross and I are co-founders together, because so when I resumed travel this past year, I had 4 trips to Asia, 4 trips to the Middle East, 3 to Europe. I actually am en route to Sweden tonight. And I think what we find is that, to be fair, trust is not actually built on Zoom screens. It can start a connection, but when you experience something in person, like a meal or a sporting event or a fitness class or a hike. But I think the thing that Ross has also watched is like the travel can be exhausting, and it's very, very hard when we have so many investors and we love what we do, that we found that the marketing machine Ross built is the great follow-up, and it allows time as we want to give what we would say the high touch to every person that we meet. And so I think that what you'll find is like we do white papers, we do webinars. Our LinkedIn, to Ross's point, is incredible to see how many followers that you can have as a private equity firm. And we're small, but it's just unique to have like a team focus on that. But I think that we did learn during COVID. Ross and we actually mailed out 400 hot cocoa boxes at one point of like, here's a healthy hot chocolate and a homemade coffee mug, and let's do like a, a hot cocoa toast. And I think what we found is that people, as you know, they never forget the way you make them feel or the experience, right? And so you can talk about the returns and the deals, and they like that, but they really like the way that we deliver an investor experience.
Yeah, I mean, and that parlays into employees too. I mean, when you have a brand, I mean, we had over 1,400 applications for our most recent job posting. And so, I think what you're going to find, and back to maybe connecting it to that asset class, Joe, is there's a lot of great consumer investors out there. There's also a lot of great big consumer shops that like health and wellness, but it typically is a small team within a much larger organization. So, the founders don't really get access where we just throw everybody in it. And like, this is all we're ever going to do is health and wellness. So I think there's a difference between being a division within a giant firm and being built exclusively for this asset.
Ellie, I think you mentioned it a couple of times, maybe initially starting out around food and beverage and now broadly around wellness and just the way that we describe it is, wellness is whatever you say it is. Different people define it differently, and that definition continues to evolve. How do you think about where you're focusing in this health, wellness, health optimization, preventative care, like all these words that are now bucketed around health and wellness?
I always tell people we did start around this concept of category creators, mainly in proteins, right? We take a huge protein bet at a time where people were focused on plant-based proteins, and we were predominantly focused on eggs, beef, dairy. And you see that in our portfolio, right? And all of a sudden, as somebody who I always say I see the world through four lenses, as an athlete or washed up former athlete, I like to say, but also as a health optimizer, because I've had to overcome health issues. Like it is sort of top of mind of what do I need to do to stay healthy, especially as I travel. My travel routines look like athlete routines, even though it's just preparing for meetings and going to the airport every night, basically. So that thing, but I would also say as an avid consumer, and this is where I think building out a team that's now 22 people, we have far broad and beyond a firm that may have started around my passion or health story, in the sense of almost everybody in the firm has a unique health story or somebody in their family or something they're focused on. And I think what that's translated into is been a sort of, I would call, health unifier of we're all on the same mission. And I think that's actually been more of a conscious effort for Ross and I of like, let's get this out of being Ellie's health story. I wasn't personally comfortable with that. I'm comfortable with like being a co-founder of Ross and I are, still building the firm. But to be able to succeed in being called an asset class, you have to be able to say that this is something appeals to the masses. And so let's talk about health and wellness, right? What we found in statistics have been people that were already leaning into food and beverage were then going from what's in your fridge to what's in your medicine cabinet, or maybe what you want to replace out of your medicine cabinet, and then your gym and your healthy home. So we see it in three areas: food and beverage, which we call nutrition; active lifestyle, which can mean recovery, sleep, and healthy home. And I think that it's when you have a team that is already the consumers of the products by nature, the ideas are coming into the firm, and that has been helpful. I will say there's definitely an uptick in VMS deals compared to food and beverage. And I look at my own morning habits that are insane. I think you could make a TikTok of what my morning smoothie looked like, right? The amount of powders that are now getting added into this in whatever color that they are, I think speaks to how people have moved away from this is prevention healthcare versus they actually find joy in their health routines. And that's where I think we've focused more on has been if you're already eating healthy and maybe you don't want to take a pill, but powders and gummies or in sort of the VMS category. So like we say wellness broadly defined like you, but I think back to what we do, our job is to be best in class. So that means category creator. And I'll let Ross talk about, I mean, Ross plays a unique role on the investment team. Unlike me, I want to look at every brand and every product. Ross will strip out the names of the companies because he's just looking at the unit economics and the financial metric. And I think that that's what's been part of our success is we all fall in love with brands, but as an investor, which I would say is the last category, you really have to be careful because there's plenty of brands that we all use, and I could go on, and so many of us can, but that doesn't mean that they're investable products.
Yeah, and maybe to build on that, Joe, I think, you know, you see money swarm to some of the really trendy items, and it's either because of use and there's like a justification behind why they invested, or you see founders that try to kind of say, hey, I'm in a hot spot. I'm going to fluff up my valuation and either get out now or I'm going to get a really high valuation. I don't think that's in the benefit of anybody. I mean, if take a step back and just begin with the end in mind and say, how could I get my 10-year-old son to feel better day in and day out, or my 86-year-old grandmother feeling day in and day out? Is you want a good product that's accessible that they can incorporate into their daily lifestyle. So just play out the example. Founder takes something that's at double the valuation it should be. From there, the investor's trapped. They have to raise prices in order to build profits of the company. So now you've just reduced accessibility. They need to do different product launches in order to gain market share. Those product launches are really hard. A lot of them tend to fail. And then poof, 4 years later, the company's gone. And my 10-year-old doesn't have access to the product anymore, or my grandmother doesn't. So I think there's this like there's also a marriage of the investor and these founders. And we really spend a lot of time trying to suss out, does this funder want to make society healthier? Because if they do, there's a really good chance when things get tough and you're in the trenches that you're going to make really good decisions. So just a little insight into how we kind of transcend, the thematic into the boardroom.
One thing I wanted to touch on, and it kind of relates to that, is like this idea of building a category. So betting on brands that are building and defining a category, but doing that at a stage where you're talking about putting 25 plus $1 million into a company. It's like usually when I think most people and maybe even myself tend to think about building a category or making that bet. It's like it's at a very early stage. It's still unproven. Like the founder might have a kind of wild vision for the future that they want to exist, and you're placing that bet then at that early stage. Where does this category creation and like private equity growth stage like really marry in a way where it's like you obviously want those unit economics to be there, you want the momentum and proof to be already playing out, but it can't be so far that the upside is no longer there.
Look, I think Ross once said to me a statement that's so accurate of what we see in our portfolio, which is like, do you want to be the athlete, the coach, or the owner? Right. And so we always say we're in the people business. And Ross and I spend more time on talent than people would realize in our day to day. And so a couple years ago, when we brought in Steve Young, he's an operator from General Mills. He's had several successful exits, sort of went on the natural channel in General Mills. But we mentioned that because what we have found is that founders, when they're coachable and you help them and you build the management team, I'm not going to say it's easy. The question is, do they have the right people around them to help them with that? And so much of what we do, and I would say Ross has, in some ways done that for me, is try to bring out the best of the founders. And that's what so much of this is, that I think that a lot of other firms don't have this emphasis on the people side. They just focus on the numbers.
Categories that are being created now are really hard to underwrite to. So if you talk about category creators, like when we did the egg business, we looked at the overall addressable market. We went over and looked at in the UK, like 65% of all eggs were pasture raised. And we're saying in the US it's 1%. So we saw like a huge market to win into. But take like we use the pickleball example a lot in this active lifestyle at Manna Tree. Would I have wanted to invest in pickleball 5 years ago? Probably not, because the addressable market was tiny. Now it's predicted to go to 7 billion in size. So then you look at, well, how much of like is this brand? Can they get to 200 million of revenue within that 7 billion? I think the watch out, Joe, is where when the predicting of the category growth. So I don't know what pickleball is today, 2.5 billion. So if you were to tell me that pickleball is going to triple in the next 5 years, I would probably want to challenge you on like, prove to me why, like prove to me where the demographics are. prove to me where the socioeconomic spending is, because the big watch out for growth investors later stage is, you just hit a revenue point of like 70 million and you just can't go any further. Like it's gone. You've absorbed all of the market share. And I think you've probably seen this a lot too, is like the health and wellness consumer is very transient across product sets. So what we really want to look for is we want to look for more durable sectors. And sometimes we can't find the brand. And before we got going, I was telling you about this protein bar manufacturer. We just said, hey, you go to the grocery store, there's like 26 feet of protein bars now in an aisle. Maybe we should own the manufacturer that manufactures half of them. And that's also a way that we can support the industry. Whereas we can keep protein bars affordable. We can, make sure that the next evolution of functional ingredient goes into our protein bars. But we couldn't for the life of us figure out which protein brand bar was the one to back.
I think other firms traditionally in private equity have had a rinse and repeat model, which is fine, but supply chains are different. And so I go back to the ag background of eggs are different than beef, beef is different than dairy. And so if you take a company like Good Culture, when a company goes viral on TikTok and you are the category creator of cottage cheese, it's while it's a great company and an amazing founder, it is a hard supply chain to deal with if you're an asset light business, right? And so I think that that's where we've had to really lean into our strategic network and have the right dairy relationships. But on this addressable category, sometimes when we went into it, it may not have been big, but we made a protein bet. And so if you just said we made a protein bet, we were able to have protein bars, meat stacks, dairy, eggs. And so we just thematically said, and that came out of some of the research I was doing, is we're going to make a protein bet. But I think making the bets are you have to do, but then you also have to pick the winners in that area. And that's where I've seen sometimes they may not do the macro of the total addressable market. And then is there longevity in this? I don't think people are going to eat less protein. I don't think we're going back in that. I think there's an awareness now, and that's what somewhat's played out.
Joe, what do you think? What do you think about protein? Is it here to stay?
I mean, I think it's at this point undeniable that, especially when you look at the shift around not only people welcoming this idea of like the way that we've phrased it is like muscle mass as a longevity metric, like as a health span metric. And this conversation around when you have folks like the Peter Attias of the world and Dr. Rhonda Patrick and so on and so forth talking about, lean muscle mass as an indicator of both length and quality of life. I think, yeah, people are going to continue to be stacking that protein, whatever it is, 2 grams per pound of body weight, even though that was kilograms, and that has
Right,
gotten
right, yeah, yeah.
skewed, and
I
people
think I
don't
read that
really,
on your site.
yeah, don't really get that metric quite
No,
right. But like the
no,
idea of more isn't going anywhere.
no.
I wanted to ask kind of a follow up around this creating and defining categories, because I think it is something that's so interesting. We're constantly trying to do it and synthesize what's happening and really put like coined terminology, like really interesting phrasing around these, the personal health OS as it relates to like some digital health platforms and things like that. But how often are you finding the category and backing into the company versus finding the company and then doing the diligence on the category? Are you working in tandem in doing these things, and how do you triangulate that?
That's a great question. I mean, if you looked at we do both. So we have a team that, and I'm not going to share all the secret sauce here, but we probably have a 90-page deck where we've gone category by category, and then within that we've got subcategories, and we can look at the CAGRs for every category. We can look at the adoption rates. We can look at the margin structure. So that gives us like the framework. And usually what that does is when we get the inbounds, I mean, we look at, I know this year maybe we'll get 450 opportunities that come into our doors. We can then quickly put them against a category so we don't waste a lot of time on the ones that aren't there. But once we get into those 50 or 60 qualified ones, that's when we kind of flip it. And then we want to look at what makes that company special.
The other thing that we've seen is that we are working and meeting founders far earlier than we ever did. I would say a lot of times we used to get venture deal flow. I think sadly there's just not as many venture firms around anymore. And I do think with the rise of social media, founders are able to get further than they can. And I think that they try to take it far and then they realize maybe they need help. And so I think it's new for us to have this 2 to 3 person team. They're just meeting with founders. And I I have also watched that where the products come from. I have two theories on this. One, I think that when you've had successful CPG or sort of health and wellness exit, those founders tend to reinvest back into the ecosystem. And so they're nurturing and advising the next generation of founders. And I found that there are certain geographies, and there may not be the sort of sexy cities you would think they are, but it's where those founders live that the next great deals are coming. And then, secondly, that we've definitely seen is that it used to be these companies would go to Whole Foods or Sprouts and debut there. I would say that it is now where people shop in health ecosystems that they can trust. And if that's, I know you've had like Next Health or any of these sort of biohacking type places, or your local smoothie shop or a chiropractor or a PT or a gym, people are finding products there. We call that a store within a store. And those are usually where these early consumers that then share on social media and help these companies grow fast, that by the time they're in the store, I wouldn't say that they're kind of the category creator of the next hottest brands that we're seeing. So we've adapted our own methods. And I think our team, who are avid consumers of this, I myself as well, like we'll buy products and come home and, share it with the team. We're like, well, what is this? Where is this? Because we're all sort of, we are in that consumer category. So those are two different things I've seen. The third one I've seen is definitely, while we are not in the kind of tech plays, I call it the everyday biohackers. If you're somebody who has an 8 sleep mattress or an Apollo or an Aura ring, and then you get this data, and then you go buy a consumer product, and then you see a shift in your health scores or your readiness scores, then they go and try something new or they double down on it. And I think that having that accessible data has allowed people to try more products than they usually would have before.
I mean, I talk about that with our institutional investors, Joe. I mean, we're trying to unlock billions of dollars of capital to put into this sector. And when you go to an institution and you talk to them about the rise of that asset class, the generational spending is undeniable right now. And I think to Ellie's point, what you're going to have in the next decade is the diagnostic tools and the data set for all of us is going to get so cheap, and we've tested so much, but then you have to action it. And what are you going to action it with? You're going to just change your shopping cart, or instead of buying, I always give the example of like the Gen Zs are not going to upgrade their Mercedes. They're going to spend that next $15,000 on supplements and wellness and gym memberships. And I firmly believe that you're going to see the legacy products of the upper middle class continue to shift into share of wallet, where I think right now an average American spends like $5,600 a year on health and wellness. That could triple to quadruple in this next generation once we get the data, and I think that's the marriage. I think you've got this early adoption going on right now, but the masses are definitely coming.
This episode of the Fitt Insider Podcast is brought to you by EGYM. EGYM makes some of the most innovative strength training machines on the market, but that's only one part of their integrated ecosystem. With connected fitness equipment, AI-powered gym software, and a comprehensive corporate wellness offering, it's forging the future of preventative health. Partnering with companies worldwide, EGYM's WellPass program improves employee health by expanding access to premier fitness and health facilities. Upgrading gym floors, EGYM equips every operator with smart equipment and AI tools to create hyper-personalized training plans for every exerciser. Putting it all together, they're transforming healthcare through exercise. Experience the power of EGYM's ecosystem at egym.com. It's so interesting to think about, especially for this group here and then the listeners as well, this idea of the wellness category being early, that when you look at other, we talked about sports, or you talk about SaaS, or you talk about fintech, you talk about all these other industries that have already gone through this, having the data, having the attribution, having the diagnostics, like all these things on the back end. Wellness is so much of it has been just on feel and vibe and aspiration. And now once we get to this point of being able to back it up, and to your point, like really validating that spend, like then that becomes the status quo, and then everything kind of builds from there. Whereas now it's still this gray area that does create the distrust or the uncertainty around continuing to invest or continuing to build in this space or fund this space in some instances.
When electric cars came online and like you had the early adopters, but we're still not fully adopted, but at least people have the information. And then what it did is it sparked all of the legacy products to start chasing EVs. That's what's happening in food right now. Like you start to see the declines, the breakup of large companies, the legacy companies that just their products aren't growing anymore, and that they have to invest. So I do think there's going to be another wave of venture activity coming. It's just we had to get rid of kind of that tail of, I think Ellie mentioned, a lot of the plant-based investments went south for a lot of investors. Liquidity dried up. But I would say in 24 months from now, you're going to start to see another group of investors come to the table, because why would you not want to be part of this asset class?
When we started, we always had the health angle. We probably were not the sexy firm because everybody was on the plant-based side of it, and we were very strict about being around health. There are data out there that I think has allowed us to build our firm in a way that's gotten here. And I realize there's two men on this podcast, but I have to share it. So, look, 90% of food in the US today is purchased by women in the household. 85% of all consumer purchases are made by women, and 80% of all healthcare decisions in the family are made by women. And one of the first things I said to Ross is, that voice is not represented in a consumer investment firm. Believe it or not, Ross and I still deal with people saying we don't like consumer. That has actually shifted in the sense of, you say, well, if 68% of GDP is consumer, where were you basing that data off of, right? And you could say it was arguably luxury goods, private equity firm. But what we know is that the luxury goods have been in decline, right? But it's the health and wellness spend that's increasing. Okay. I think the other thing that sort of from a economist standpoint that I think is shifting is traditionally the way that you look at data of where food is consumed is in the home and out of the home. And in the home means assuming people are cooking, and out of the home is at restaurants. Cooking is in decline, and people are not just eating at restaurants. There's the rise of the sports and the concert scene, right? And so when you start to look at the data of what is being consumed outside of restaurants or in the home, I would say that's where you start to see the health and wellness spend, because the health and wellness spend, 40% of this is really the Gen Z and millennial population, and this is sort of the social wellness trends. And so that's not consumed in a normal place. So like any category, innovation has outpaced it, but I think that you're starting to see the better data come into it. And I think that's something that we really do watch.
What type of pushback, if any, is there from limited partners and other investors, institutional capital, saying like, no, we are not fully bought into this space, and maybe we don't believe in it? This is the type of things that they're pointing to say these are the reasons we are not funding or not interested in participating, as this seemingly obvious thing is playing out in front of us.
So we used to hear that. And now, interestingly, I think because your point, it's everywhere and it's in your face and you can't ignore it, we don't hear that anymore. And so we used to write white papers on this subject. And I think that our marketing and education, to be fair, I think has played out. I also would say that there's the consumer sector, but I also think that there's the other themes that in an investor's bucket you have to look at. There's so much tech money going into people's investment portfolios that people now are saying we have too much invested into tech and we're under allocated in consumer. And they genuinely agree that if they're going to invest in consumer, health and wellness, i.e., in fitness or better for you, is the place to be. But on the niche part, Ross and I used to get that a lot because we started the firm where we said food is an asset class. I don't think you can make a convincing argument of this food as its own as convince is an asset class. But once we sort of brought it into sort of the better for you health and wellness, what you really look at is it's a hedge against healthcare, is what we like to say. Because it's really like we think of ourselves as a triangle. We're usually manufacturing brands. So investors like to say they make money in unsexy industrial manufacturing. And we're like, well, we do manufacture our food. This is not just a consumer brand that's, spinning up so fast and doesn't have control of their supply chain, right? And then the other thing is that, yes, we underwrite to consumer revenue, but there have been successful exits in the space. And so we educate on that. And once you have successful exits in the space, investors are usually fine. And the third is, I think healthcare is so regulatory dependent that usually those tend to be things built back to insurance or not, because of denials. But in this case, this is disposable cash income that even in the era of geopolitics, the one thing people aren't pulling back on is their health and wellness spending, because it's the one thing that makes them feel good. And so when you present investors with that data, there's a very compelling argument, and we're actually finding tailwinds behind that.
Yeah, I think, Joe, too, like, I get the benefit of talking with some of the best investors in the world. So, and I can have a call with somebody in Kuwait in the morning and somebody in Singapore in the afternoon, and they're speaking the same language. And I always say it's like, what is like 99.7% of our DNA is all the same. And so when it comes to health and wellness, we actually have products now that are transcending borders. It's like, it's not as, think of a lot of consumer products that are hyper regional, and some of those do actually really well when you bring European products to the US. But the health and wellness thing, it's people are using the same apps in Switzerland when I'm talking to them. And, they're using the same DTC products that they're buying online that you're seeing in the US. So I think people are recognizing that. The other thing I would say is if you go around the globe, a lot of the families own the distribution of the grocery stores. They own the agriculture and food assets. Why? Because it's disposable. Like people consume this stuff every day, and it's built a lot of the billionaires around the world. Our country's a little different because the corporations took over so much of that. When you've got these giant private corporations like the Cargills of the world, or again, Mars, General Mills, I think what you're going to see is you're going to see everything fragment again. And even a lot of high net worth families in the US. I mean, we all know that like Bill Gates owns the most farmland in the US. There's a reason for that. I think people are going to start to see these types of industries as things that they would like to just place long term capital in. And I think that's going to unlock a whole nother interesting thing where, again, you don't have these big run up IPOs or these overpriced IPOs that then crash. And then the investors don't like because their bike that they were riding that they thought was going to make them billions of dollars isn't printing money anymore. I think that's what would benefit from in the US is just a different capital structure.
Building on this, just this idea of, not only where you sit in terms of Manna Tree, but other people who are thinking about how this sector is being funded. It is difficult at times to not chase the flashy thing, the hype. We kind of talked about, where the interest in money and maybe marketing is flowing, and then that bubble kind of pops, and there's a couple of them forming and getting close right now that I think we'll see play out. But then this idea of the food and beverage versus broader wellness versus the tech versus the manufacturing. Do you think as we think about continuing to build this infrastructure and really funding it, this leads to the kind of firms like yourself and other ones being more specialized or more kind of broad in terms of where they're placing those bets and how that ends up contributing overall to the category? Because I can kind of see it going both ways as you're talking about it. Like obviously the specialization, the experience that you all have to know the kind of ins and outs, but then also given that the category is becoming so expansive, like that opportunity is almost too good to pass up. But maybe that's the catch.
There's several other firms out there that do a really good job, and we need them out there for larger institutional investors to like our category, but they also specialize in different areas. We're not a big beauty investor. We're also not a big biotech investor. And I think that you're definitely seeing, like in the longevity space, a lot of that is more in the biotech or on the venture side. It is definitely what we would say are larger, expensive tech based purchases. And so we tend to say we are in the multiple daily or weekly repeat purchases. And so what we know is retail and DTC brands and supporting founders and building great businesses, right? And so to really say, well, where can that happen? We don't do pet. We haven't done that. So I think like everybody is sort of finding their place. And surprisingly, I think because we've all been in this battle before, of people don't really like consumer, there's more support than you would see in that, like, you want somebody to have a home run because we all need the exit. So the specialization has already sort of happened. I think that on our case, like the sort of fitness angle, I think I don't see others combining fitness with food and beverage yet.
Part of the reason it is bifurcated is each asset class has a different return model. And so you kind of have to do that, right? Like the biotech return model, they might be underwriting to a 10x. We're going to be much more conservative and underwrite to a 2 to 4x because, we feel like that can produce a predictable model. Usually institutional investors would rather have predictable returns. And so, it just doesn't allow us to look at certain types of deals. What I would say though is many people are starting to figure out just share of wallet. And so Ellie mentioned the store within a store model before, which I think is a good one. I'm really curious on where the wellness real estate world is going to go because you look at captive audiences, you've seen the major, things like the Sensei come into fruition. There's a ton of new resorts. I think I just saw the latest one was the Fitness Temple. I don't know if that posted on your site, but like then all of a sudden you have a captive audience. Are you going to be selling them subscriptions? Are you going to be providing them their supplements every month after that? So I think it's access points is also a diversification for how firms can look at getting into the share of wallet.
Honestly, when you travel, there's no 8 sleeps when you leave your house, right? Like, think about it, and it is interesting, but I also think that what still has to happen, because I'm predominantly overseas in any given year, is that I still have to bring protein powders and vitamins. You really cannot get those types of brands as high quality overseas. And so the number one place for the health and wellness economy today is still the US. The want is for that to go overseas. And I think the way I explain it to people is when you land at an airport, it's almost all luxury goods. There is no hyperbaric, red light, here's a vitamin shop of things that you want to feel better for jet lag. That's coming. It has to start to change because the hotel rooms don't match it, the airports don't match it, right? And a lot of these stores are not busy anymore. And so I think the other thing I always tell people is even in the airports and the TSA, we're way behind. They don't even know what these products are in the US. And if you think they don't know if in the US, try taking like a Normatec overseas. They don't know what the battery is. So, like, the innovation is still in the US. I think the next wave is that it will continue to go more global, to be honest. And I think that the products are amazing of what we have in the US. They really are. But most people just still want access to them globally.
This conversation has been so much around these tailwinds, the trends, the shift in culture and consumer and capital, like all those things moving in the right direction. Not to, bring the vibe down, but how does it go wrong? Like, where do you see the kind of roadblocks or barriers? Because that's something we spend a ton of time thinking about as well. Obviously, one being just like cost and accessibility and the luxury framing of so many of these things are happening. But beyond that, are there things that you've already identified as like, hey, we need to have these things top of mind, especially in specific categories as we continue to place these bets?
I think a lot of information flow, right? Like that could go wrong. I think one of the reasons the industry is booming is because the information flow is going right. Like we finally have like credible people that are on the air podcasting, others that are doctors are credible. You go back 20 years and there was doctors being hired by big soda companies to give false information out there. And so I still think there is a risk if, for better or worse, the consumer will move with information. As long as the information remains pure, people aren't trying to bend health information to sell their specific product. I think the distrust in the consumer is where it could stall out. But I think there's enough good guys out there. And I think there's enough people that are transforming. And then obviously we're trying to make sure that we can capitalize on more of a non-political health movement in this country, which is kind of cool. It's like one of the first times that we've had a societal thing that I think you've got both sides of the table wanting to promote in their communities. And that could be a huge opportunity, but that also could go wrong if for some reason somebody decides to put a stake in the ground against a certain category or product and then it stalls out an industry.
I think that the things that are positive are things we didn't have when we started the firm. The democratization of healthcare and having your data on your, phone or on your ring. People didn't have access to that. So it was basically their consumer purchases and they wanted to have brands that they trust where their share of wallet was. But I also think that there's been such a distrust in our sector that I don't know how you go backwards because just like we said, if people have a health episode and they change their diet, they don't usually go backward. I don't see people going back to heavy prescription meds or I think people now want to take charge of their health and feel better versus talking about how awful they feel. I think it's more of a mindset and where you spend your dollars and your time. So I think that what you're watching is the prevention economy is here. And I think and there's an acceptance of a parallel economy of we have sick care and we have prevention. And I think people most of the time, sadly, I think statistics show if you have 88% of the US metabolically unhealthy, we've at all at one point probably been on the other side. You don't really want to go back. So I think that that's just been the movement of storytelling and people being much more honest and vulnerable about their health issues. When we started the firm, I was unique. Ross probably hated it. I talked about all my health issues. That is so prevalent out there today that there's sort of this shared excitement of, we're going to kind of get each other through it. And I think for better or worse, as Ross said, they're doing it through brands they trust. I just don't see it going backward. As somebody who's, I would like to say, in the health optimization category, I don't even call myself a patient anymore. I've kind of overcome more things than I would have thought just by my products. And I'm very proud of that.
For sure. I think it that all is a strong signal for where the category is heading because it's all of these things that we've seen play out before, not to get too far on a tangent, but not that long ago, the idea of doing yoga was weird. It was fringe. It's like, oh, what is this thing that you're doing? And now it's not only is there a yoga studio on every corner and Lululemon and all these things, it's already transcended that, where that's just a normal thing. Now that's mobility and flexibility, and it's just part of this routine. And as that same thing now, we're very much in that era where not that long ago, forget Brian Johnson, Dave Asprey was considered like on another planet. And now it's like, that's pretty much every conversation. And to some extent, like you said, Ellie, is like the everyday biohacker. Soon it went from quantified self to biohacking to longevity clinics to prevention. Then it's just going to be wellness. It's just going to be whatever the word is.
We saw this. We studied this. Is Beyond Meat didn't invent the plant-based category. There was tofurkey before. Remember, like the aisle that nobody wanted to buy things in. What they did was product placement, and they put it right in the beef aisle. And I think that that's what sort of this biohacker economy has done. Is they put it front and center, front and center. And so, to your point, Joe, it's right there. Lived in LA 15 years ago. I remember Earth Bar, and actually Sun Life Organics was like what the first one out there, but you could only get that stuff if you were in Southern California, right? It's everywhere now because it's what people want. And I think that we definitely see that data of sort of how these places have gone to, multiple location. I don't think it's going back. The one other comment I would make on that though is I do think that there's a better acceptance now of what it takes to have a winner. And I think that we've had founders become much more humble and say, I want to partner with someone who's going to help me get the best outcome versus you really can't get away with now of like a founder wanting to have so much control and not a great partner. It's like my analogy of you may have a star athlete, but it takes a team and it takes the right coaching and the right ownership group. And I think that there's an understanding now of they want to build the best team. So I think that's what's changed.
There's a huge opportunity and a clear need. And I think at the intersection of that, then we get this thing that we keep coming back to, which is like almost that it's undeniable in the sense of either we're going to continue to improve the status quo in health and prevention and wellness, or we go the complete opposite direction, which is, everybody continues to be unwell and chronically ill, and all the rates of every disease continue to grow. So it's fundamentally like, not only is this a great upside for investors and an opportunity for founders to have an impact, but the outcomes are so clear that it's like we have to continue to raise all ships as we go. So I appreciate you all spending some time talking about that today. And I think for folks who are interested in learning more, you talked a lot about just different educational resources and webinars, maybe newsletter, white papers, or just learning more about Manna Tree. Where would you point them? Anything else that you want to plug or direct people to?
Yeah, I think find us on LinkedIn, Manna Tree, and then mannatreepartners.com. You can find our white papers and to download it. And, we love being part of the ecosystem. So please reach out.
Perfect. Thanks so much. I'm excited to share this conversation. Thanks for being here. And looking forward to spreading the word.
Thanks, Joe.
Thanks, Joe.
Thanks for listening to today's episode. If you got value from the conversation, please consider subscribing and sharing the podcast with a friend or colleague. It's a massive help. And if you want more content like this, including news and insights on the latest industry developments, subscribe to the Fitt Insider newsletter at insider.fit.co. And one more thing, you can learn more about our recruiting and consulting services at fit.co. That's FITT.co. I'll see you here next week.